Hey there, savvy investors. It's Investor here, bringing you another exciting investment adventure. Today, we're diving into the world of ETFs. Not just any, we're talking about the crème de la crème of monthly dividend ETFs. That's right, the ones that drop a dividend into your account monthly like clockwork. Imagine having a steady income stream 12 times a year rather than the typical quarterly dividends. Sounds pretty great, right? Well, I've scoured the market and handpicked 6 stellar ETFs that promise this monthly payout and offer the highest dividends. This means more money in your pocket more regularly. We're all about making intelligent, informed decisions in investing, and there's no time to waste. So buckle up and let's explore these top 6 monthly dividend ETFs poised to supercharge your investment portfolio. Get ready to discover how you can get the most bang for your buck and turn each month into a celebration of dividends. Number 6. WisdomTree US High Dividend Fund, or DHS. Kicking off our list at number 6 is the WisdomTree US High Dividend Fund, also known as DHS. This ETF is a one-stop shop for those seeking high dividend yields from the US stock market. It does the heavy lifting for you, handpicking the highest dividend-paying stocks so you can skip the tedious research and directly reap the benefits. By investing in DHS, you're giving your portfolio a VIP backstage pass to some of the most generous dividend payers in the market. Picture this. Out of the 315 stocks in DHS's basket, you get pieces of well-known names like Pfizer, Cisco, Verizon, AT&T, and Coca-Cola. These aren't just any companies. They're solid established players, which is why DHS doesn't just promise high dividends, but also impressive performance. Over the past decade, DHS has clocked an average annual return of about 11.57%. To put that into perspective, if you had invested $10,000 in DHS 10 years ago, your investment would have swelled to nearly $30,000. And that's on top of enjoying a juicy dividend yield of 3.77%. Finding one that combines robust growth with a high dividend yield in ETFs is like striking gold. Some of you might think, 3.77%? I've got stocks yielding 8%. Well, sure, stocks like National Presto Industries may dangle a 7.48% yield, but beware of the dividend trap. A high yield is tempting, but you're catching a falling knife if the stock's value plummets. DHS, however, maintains a balance between yield and growth, steering clear of such traps. Well, let's talk about the risk and cost of owning DHS. On a risk scale of 1 to 5, I'd rate DHS as a moderate 3. It's not the safest bet, but far from the riskiest. As for the expense ratio, DHS stands at 0.3%. On a $10,000 investment, you'd pay about $38 annually. Anything below a 0.5% expense ratio is considered affordable. So DHS fits snugly in the reasonably priced category. In summary, DHS is an excellent choice for income investors looking for monthly dividends. It strikes a delicate balance between risk, return, and cost. However, it's just the first of our top 6, meaning there are 5 more potentially even better options waiting to be explored. Stay tuned as we climb higher up this list. Number 5. S&P 500 High Dividend Low Volatility ETF, or SPHD. Moving up the list to number 5, we have the Invesco S&P 500 High Dividend Low Volatility ETF, known as SPHD. This ETF is a beacon for those seeking stability and income based on the S&P 500 Low Volatility High Dividend Index. This index focuses on the 50 less volatile yet high-yielding stocks in the S&P 500, making it an ideal benchmark for income-driven investors. SPHD offers a portfolio of 51 stocks, including familiar names like Iron Mountain and ExxonMobil, and some lesser-known but equally promising companies. Since its inception in 2012, SPHD has demonstrated solid performance with an annual return of about 11.03%. Imagine turning a $10,000 investment in 2012 into over $23,000 today to visualize this growth. This growth and a high monthly dividend yield make SPHD a standout choice. But wait, there's more. The dividend yield for SPHD is an attractive 3.86%. Don't worry if you need clarification on how dividend yield translates to actual earnings. We'll break that down later in the video. Stick around for that. Regarding risk, Morningstar rates SPHD as a moderate 3, a fair assessment given its focus on low volatility stocks. Its expense ratio of 0.30% translates to $30 annually per $10,000 invested, making it a cost-effective option for those looking to maximize their income potential. For income investors or those aspiring to live off their dividend payments, SPHD is a solid bet. It offers a balanced mix of stability, income, and reasonable costs. But remember, we still have 4 more exciting options, each with unique strengths. Stay tuned as we continue to unveil the top picks for monthly dividend ETFs. Number 4. Invesco Preferred ETF, or PGX. Climbing to number 4 on our list is the Invesco Preferred ETF, better known as PGX. This ETF is all about tracking the performance of the ICE B of A ML Core Plus Fixed Rate Preferred Securities Index. And yes, I often wonder if these index names could be more creative. PGX is a market cap weighted index designed to measure the performance of fixed rate US dollar dominated preferred securities. Sounds complex, right? Well, let's simplify it. PGX focuses exclusively on preferred stock. These are unique as they offer set scheduled dividends, much like bonds, but with a key difference. They provide part ownership in the company, unlike bonds. Preferred stocks are famous for their higher dividend yields than common stocks, which most retail investors typically dive into. PGX boasts a portfolio of 301 preferred share issues, featuring major players like Citigroup, JP Morgan Chase, and Wells Fargo. Now, let's talk numbers. Over the past decade, PGX has delivered an annual return of about 6.73%. To put it in perspective, a $10,000 investment in PGX 10 years ago would have grown to nearly $19,000 today. And that's not all. You also get a dividend yield of about 4.87%. The cost of investing in PGX is slightly higher, with an expense ratio of 0.52%. This means you'll shell out $52 annually for every $10,000 invested. Considering its investment in lower risk preferred shares, PGX rates a 3 on the risk scale, making it a safer bet for those cautious about market volatility. In summary, PGX stands out for its focus on preferred stocks, offering a high dividend yield with a moderate risk profile. It's an attractive option for investors looking to add a mix of stability and income to their portfolio. Yet we still have 3 more impressive ETFs to explore, each with unique appeal. Stay tuned as we continue our countdown. Number 3. Global X Super Dividend US ETF, or DIV. Marching up to number 3, we introduce DIV, also known as the Global X Super Dividend US ETF. This fund takes a slightly different approach from our 5th-ranked ETF by investing in high dividend-paying stocks with low volatility across the U.S. stock market, not just within the S&P 500. DIV's portfolio comprises 50 of the highest dividend-yielding stocks in the U.S., including notable names like CubeSmart, Public Storage, and Pfizer. Launched in 2013, DIV is relatively new to the scene, so we don't have a decade-long track record to analyze yet. However, DIV has seen an average annual return of about 4.6% since its inception. While this growth rate might seem modest compared to others on our list, DIV stands out for its dividend yield. Boasting a dividend yield of 5.80%, DIV currently holds the top spot on our list for yield. However, it does walk a fine line with its expense ratio, coming in at 0.45%. This means an annual cost of $45 for every $10,000 invested. It's worth noting that while other ETFs on our list may offer better overall investment potential, DIV ranks highly due to its focus on monthly income, a key criterion for income-focused investors. But it's not all roses. The combination of investing in only 50 companies, along with its lower returns and higher expense ratio, pushes DIV higher up on the risk scale. I'm placing DIV at a risk level of 5. This rating reflects the increased risk factors associated with its narrower focus and financial performance. As we near the climax of our list, the anticipation builds. The final 2 ETFs are set to impress with some of the highest dividend payouts on our list. If you're eager to discover these top dividend performers, stay with me as we unveil the cream of the crop in the world of monthly dividend ETFs. Before we dive into the second top ETF on our list, here's a quick reminder. If you're finding value in this video and are eager to keep up with more insightful investment content, make sure to hit that like button, subscribe to our channel, and ring the notification bell. Your support helps us continue to bring valuable investment insights directly to you. Now, let's explore number 2 on our list. Number 2, Global X Super Dividend ETF, or SDIV. At number 2, we have SDIV, or the Global X Super Dividend ETF. While similar to the previously mentioned DIV, SDIV has its unique twist. Unlike DIV, which focuses on the US market, SDIV expands its horizon globally, investing in 100 of the highest dividend-yielding stocks worldwide. Currently, it holds 104 stocks, with top holdings in companies like China Power International and Yangzhou Coal, among others you might not recognize. Over the past decade, SDIV's performance has been modest, with an average annual return of about 3.10%. A $10,000 investment a decade ago would now be valued at around $13,600. While this growth might not be as robust as some growth ETFs, balancing this with the dividend yield is essential. Typically, higher dividends may lead to lower capital appreciation, but this trade-off can be worthwhile for income-focused investors. One key thing for income investors is ensuring the value of their investment stays relatively high over time. With SDIV, while the capital appreciation isn't high, it's complemented by a substantial dividend yield of 6.83%, one of the highest on our list, paid monthly. However, with higher rewards come higher risks. SDIV's heavy investment in international stocks, which can be more volatile than US stocks, earns at a 5 on the risk scale. Investors must be aware of this increased risk, especially in volatile international markets. Regarding costs, SDIV's expense ratio is 0.59%, which is pricier. This translates to $59 in annual fees per $10,000 invested, a factor to consider for those mindful of investment expenses. As we near the end of our list, the anticipation for the top pick grows. Stay tuned as we reveal the number 1 ETF for monthly dividends, promising a standout choice for dividend enthusiasts. Number 1. Invesco KBW High Dividend Yield Financial ETF, or KBWD. Finally, we've arrived at the top of our list. Taking the coveted number 1 spot is KBWD, or the Invesco KBW High Dividend Yield Financial ETF. This ETF aligns with the KBW Nasdaq Financial Sector Dividend Yield Index, focusing on U.S. financial companies with high dividend yields. These companies typically provide financial services like banking, insurance, or loans. KBWD's portfolio is relatively concentrated, holding about 41 stocks, primarily in lesser-known financial companies. While its performance might not rival high-growth ETFs like those from Cathie Wood's ARK, KBWD has a respectable average annual return of about 8.75% over the past 10 years. This means a $10,000 investment a decade ago would now be worth nearly $20,000. A standout feature of KBWD, and the reason it tops our list, is its exceptionally high dividend yield. It boasts a 7.3% yield, making it an attractive option for those seeking substantial monthly income. However, it's important to note that this high yield comes with a cost, specifically a higher expense ratio. At 1.24%, it's more than double that of the following most expensive ETFs on our list, which is a significant factor to consider. In terms of risk, KBWD ranks at a 5. It's a specialized ETF investing solely in a limited number of financial stocks. This focus means its performance is closely tied to the health of the financial sector and the broader interest rate environment in the US, adding an element of risk. While KBWD offers the highest dividend yield among ETFs we've discussed, its higher expense ratio and specific risk factors are important considerations. It's essential to weigh these aspects against your investment goals and risk tolerance before deciding if KBWD is the right fit for your portfolio. Okay, now I want to transition. What is a dividend yield? Let's take a moment to demystify dividend yield and understand what it means regarding actual dollars in your pocket. How can you translate a dividend yield percentage into a specific dollar amount you'll receive? Well, here's the breakdown. Dividends are paid on a per-share basis. Imagine owning 10 stock shares with a 2% dividend yield. Annually, you're set to receive dividends worth $20. There's a simple formula to calculate the exact dollar amount per share based on the dividend yield. Here's how it works. Take the dividend yield percentage and divide it by 100. Then multiply it by the stock's current price or ETF. For example, let's use KBWD, which has a dividend yield of 7.3%. If KBWD trades at $20.41, divide 7.3% by $100 and multiply by $20.41. This calculation will give you the dividend amount per share you own annually. For KBWD, it's approximately $1.50 per share per year. While $1.50 per share annually may not sound substantial, the power lies in the volume of shares you own. If you owned 1,000 shares of KBWD, you'd earn around $1,500 per year in dividends. Monthly, that's about $125, a significant contribution towards your bills or expenses. The more shares you own, the higher your monthly dividend income. This strategy is how many investors manage to live off their dividends alone. Well, I hope you found valuable insights in this video. If so, and you haven't already, please hit that like button. It means a lot and supports the channel. For more content like this, don't forget to subscribe and turn on the bell notification for updates on new posts. Your engagement and feedback are incredibly appreciated. Thanks for sticking with me till the end, and until next time, take care and keep investing smartly.